This is VeriScope News. We provide verified information with clear context. Our reports focus on data, structure, and measurable trends. We do not add opinion. We do not speculate. We explain what the numbers show and how they connect. Today's report covers new U.S. labor market data and updated trade figures. These indicators help explain recent changes in employment conditions and economic growth. Weekly unemployment claims are one of the most frequent labor market indicators. They are released every week by the U.S. Department of Labor. They provide an early signal of changes in layoffs and job separations. Trade data is released less frequently. It reflects the balance between imports and exports. Trade flows affect growth, prices, and production decisions across the economy. When these two data sets are reviewed together, they offer a clearer picture of economic momentum. The latest releases show stability in layoffs, but significant movement in trade. New applications for unemployment benefits declined slightly in the most recent reporting week. Initial claims fell by 1,000 to a seasonally adjusted 209,000. The prior week's figure was revised upward by 10,000 to 210,000. Economists surveyed by Reuters had forecasted 205,000 claims. The data covered the week ending January 24th. It included the Martin Luther King Jr. holiday. Claims data often shows volatility around public holidays. Continuing claims also declined. The number of people receiving benefits after their initial week fell by 38,000. The new level stands at 1,827,000. At the same time, new trade data showed a sharp change. The U.S. trade deficit widened by 94.6% in November. The deficit reached $56.8 billion. This was the largest monthly increase since March 1992. Imports rose sharply. Exports declined. Initial jobless claims track how many people file for unemployment benefits for the first time. They are often used as a proxy for layoffs. Over the past decade, initial claims have shown wide variation. During periods of economic expansion, claims often remain between 200,000 and 250,000. During economic downturns, claims can rise well above 400,000. The current reading near 209,000 remains low by historical standards. Continuing claims measure how many people remain on unemployment rolls after the first week. They provide insight into hiring conditions and job finding rates. A decline in continuing claims can reflect faster reemployment. It can also reflect people exhausting benefits. In most states, unemployment benefits are limited to 26 weeks. Seasonal adjustment plays a significant role in both measures. Around year-end holidays, seasonal factors can distort short-term readings. Turning to trade, the United States has run persistent trade deficits for decades. Imports have exceeded exports in most years since the 1970s. Over the last 10 years, the monthly trade deficit has typically ranged from about $40 billion to $70 billion. Large monthly swings often reflect changes in energy prices, consumer demand, or capital investment cycles. The November increase stands out because of its size and concentration in capital goods. Households. Low initial jobless claims suggest that most workers are keeping their jobs. This supports income stability for households already employed. However, hiring has been described as economists as tepid. This means fewer new job opportunities are being created. Younger workers are more exposed to this pattern. Many younger adults do not qualify for unemployment benefits. This can occur because they have limited work history or have never worked full-time. Household confidence can be affected even when layoffs remain low. When hiring slows, job switching becomes more difficult. This can reduce wage growth and mobility. Trade flows also affect households. Consumer goods imports increased in the latest report. Pharmaceutical imports were a major contributor. Higher imports can increase product availability. They can also influence prices, depending on tariffs and supply conditions. Prices. Trade data interacts with inflation indirectly. Higher imports can ease price pressures by increasing supply. This effect is more visible in consumer goods. However, tariffs can offset some of this impact. Changes in trade policy can alter pricing dynamics even when import volumes rise. Capital goods imports do not directly affect consumer prices. They influence production capacity over time. Labor market conditions also affect prices. Low layoffs reduce downward pressure on wages. At the same time, slower hiring can limit wage acceleration. The combined effect is a moderation rather than a sharp shift. Jobs and labor. Employers appear cautious but stable. Economists report little evidence of a broad increase in layoffs. Some firms are reducing headcount through attrition. This means positions are left unfilled rather than eliminated through layoffs. High-profile job cut announcements have occurred. These include announcements from large logistics and technology companies. However, these announcements have not translated into higher jobless claims. Similar announcements in prior years also failed to produce noticeable increases in claims. This suggests that layoffs remain concentrated rather than widespread. Trade can influence labor demand differently across sectors. Rising imports can pressure domestic producers in some industries. In November, goods exports declined. This included declines in industrial supplies, precious metals, and crude oil. Savings and investment. One of the most notable features of the trade report was capital goods imports. Capital goods imports rose sharply. Computers and semiconductors reached record levels. This points to strong business investment in technology. Much of this investment is linked to artificial intelligence infrastructure. Investment of this type tends to be capital-intensive rather than labor-intensive. It often raises productivity before it raises employment. For households, higher productivity can support long-term income growth. The timing of these benefits is uncertain. Businesses. Businesses are operating in an environment of uncertainty. Labor conditions are stable but uneven. Trade policies continue to influence sourcing decisions. Despite higher imports, economists report limited evidence of large-scale onshoring. Manufacturing activity has not shifted dramatically back to domestic production. Instead, firms appear to be rebuilding inventories. This follows earlier periods of import pull forward ahead of tariff changes. Businesses are balancing demand expectations with cost controls. Economists are monitoring several indicators closely. First, the upcoming employment report from the Bureau of Labor Statistics. This report will provide updated figures on payroll growth and the unemployment rate. Second, continuing claims trends in the weeks ahead. This will help determine whether recent declines reflect re-employment or benefit exhaustion. Third, trade reports in the coming months. Analysts are watching whether capital goods imports remain elevated or normalize. Fourth, revisions to gross domestic product estimates. Trade flows can significantly affect headline growth numbers through net exports. Several forecasting institutions have already revised growth estimates lower. These revisions reflect the widening trade deficit rather than domestic demand weakness. The latest data points point to stability rather than acceleration. Most workers remain employed. Layoffs remain low. Hiring remains cautious. This can affect job switching and wage growth. The widening trade deficit reflects strong demand for imported investment goods. It also reflects weaker exports in some categories. These developments shape economic growth but do not indicate immediate disruption. Weekly jobless claims are seasonally adjusted using historical patterns. Short-term volatility often increases around holidays and weather events. Continuing claims can decline when people leave unemployment rolls for multiple reasons. These include re-employment and benefit exhaustion. Trade data is reported in nominal dollar terms. Large capital goods shipments can distort month-to-month comparisons. GDP calculations incorporate trade through net exports. A rise in imports subtracts from growth even when domestic demand is strong. This accounting method explains why growth estimates can fall when imports surge. This has been VeriScope News. We follow the data and explain what it shows. Thank you for watching.